Welcome back, students who are taking financial accounting, and we are continuing on with the theory videos for chapter 1, business accounting U, and we're up to the 16th in the series. So let me pick up right where I left off. Okay, and in the last video we had been we talked about making this journal entry where we're making a sale for $1,200 and we're receiving cash. And the two most important things about this were, one, that as soon as we make we have a transaction that affects either revenues or expenses or dividends, that throws our accounting equation out of balance. And the other thing that I wanted to take away from the previous video was the difference between the accounting equation, which is assets equals liabilities plus equity, versus the extended accounting equation, which includes the revenues, expenses, and dividends. Okay, I don't like to think in terms of extended accounting equation because I look at the balance sheet separate from the income statement. Right. So, with that said, our next transaction happened to be we're actually going to make a sale, but now this time it's going to be on account as an accounts receivable. So in making the journal entry for this, now remember, follow the thought process. Don't mimic what's in the book. Think through the thought process. So I'm going to have a date for my journal entry, and I'm going to have a debit, and I'm going to have a credit. Now, in the previous videos, I had said the first question that I ask myself is, am I affecting cash? Okay. And if the answer to that question was yes, then I would debit or credit cash and figure out the last half of the entry. Okay. But in this case here, when I'm making a sale on account, okay, which is affecting accounts receivable, right? I'm not affecting cash. Okay. So the answer to that question is, am I affecting cash? Is no. Right. Well, if I'm answering the question no, right? So am I affecting cash? Right? Yes or no. Okay. So if I'm affecting cash and I answer the question yes, then I know I'm going to either debit or credit cash and figure out the last half of the entry. But in this case here, I'm not affecting cash. All right. I am. So the answer to that question is no. Well, the next question that I ask myself is, am I affecting accounts receivable or accounts payable? Okay. And in this case here, because I'm making a sale on account, I'm affecting accounts receivable, right? So I know that accounts receivable is an asset because I own the receivable, meaning people owe me money. So if I have an accounts receivable, I treat it the same exact way as if I was receiving cash. I mean, accounts receivable is an asset. If my accounts receivable goes up, I debit it because assets increase on the debit side. It's just that simple. So I treat it the exact same. If I answer the question no, if I answer the question to cash being no, and I ask the question, is this accounts receivable or accounts payable? If the answer to that question is accounts receivable, then I treat it the same exact way as I did cash. Okay. So in this case here, my accounts receivable is going up. So I'm going to debit my accounts receivable by $1,900. Okay. Because my accounts receivable was zero before, and now it went up to $1,900. And since accounts receivable is an asset, and I increase my assets on the debit side, I debit accounts receivable. Well, if I have a debit to accounts receivable, and debits must equal credits, then that means I have to credit something else. And what am I going to credit? Well, what am I doing, right? I'm not buying another asset, okay? And I don't owe anybody anything, all right, because I'm making a sale, and it's not equity because it's not an investment in the business. It's revenue, and that's why another reason why I don't like this format that you see in the textbook, although technically it's correct. I like to keep them separate. So I know it's a sale, so it's revenue. And in the previous video, we had said that we increase our revenues. We increase our revenues on the credit side, and we increase our expenses on the debit side. Okay, that's what gives us our profit or loss. Our profit is going to be a credit because our credits are greater than our debits, and our loss is going to be a debit if our debits are greater than our credits. Okay, so in this case here, we're making a sale, all right? So we would choose one of our revenue accounts, and I'm just going to call this sales revenue, even though it's not on that screen. Notice I'm indenting, and I'm also putting it in, the right-hand column as $1,900. And by the way, you can't, even if you indent the sales revenue description, if you put the $1,900 directly underneath, remember that's wrong, okay, from a formatting perspective. Debits, credits, two separate columns. Make sure that you're putting the credit in the proper column, all right? So that's how you make the journal entry, all right? Let me go over that real quick. I'm making a sale. First question I'm asking myself is, am I affecting cash? No. Okay. Then the next question I ask myself, am I affecting accounts receivable or accounts payable? Yes. And in this case here, it's an accounts receivable, right? And since accounts receivable is an asset, I figure it out the same exact way that I figured out cash. Okay. Cash increases on the debit side, all assets increase on the debit side. Accounts receivable is an asset, I increase the asset on the debit side. Okay, so I have a debit to accounts receivable, and then since debits have to equal credits, I have to find my credit account. And when I look at my categories, okay, I know it's not an asset, right? Because I'm not buying another asset, I'm making a sale. I know it's not a liability because I don't owe anybody. I know it's not equity because it's not an investment in the business, so it has to either be a revenue or an expense. And I certainly know I'm not paying money out, I'm getting money in, so it has to be a revenue account. And I look underneath, I look at the chart of accounts, right, to see what account I would use for the revenue account. And that's what I use, oops, wrong way. That's what I use to make the other half of the journal entry. I indent and put it in the credit column. Okay, and just as a reminder, right, for revenues, our normal balance, that's what the plus sign represents, the normal balance of a revenue account is a credit. The normal balance of an expense account is a debit. The normal balance is what increases that category of account. Remember, revenues and expenses are categories, and the what of what increases is whether it's a debit or it's a credit. Okay. Pause, rewind, and watch the video again if you have to. I realize it's a lot of information, but if you kind of get to almost a certain extent, you're memorizing the thinking process. Once you do it again and again and again, it becomes more and more second nature. Okay. So once we've made this here journal entry right here, now our balances in the accounts, cash I have 19.2, accounts receivable I have 1,900, supplies 350, and equipment, right? So whatever that amounts to, let's see here, 19.2 plus 1,900 plus 350 plus 4,000 is equal to 24,450. And that's going to equal our liabilities of 12,350. plus our equity accounts, which is $10,000 for stock, okay? And notice that the accounting equation isn't in balance because we still have $3,100 that is over on our income statement right here, right? When we make our closing entries, that $3,100 will end up in the retained earnings account. And when it does, then our equity is not going to be 10,000, but 13,100, and then our accounting equation will be back in the balance. Okay. All right, let's see here. Okay, the next transaction. Okay. Now, we are paying, we have an our accounts payable was $350. Okay, that's money we owe, right? And so now we're going to pay that accounts payable, right? So, and we're going to pay off $150 of it. So let's think through if I had to make a journal entry, all right? Remember, I have debits and credits, okay? If I have a transaction where I'm going to pay off my accounts payable, oh, and by the way, just before I go there, I had said we ask ourselves the question, am I affecting cash? Okay. Actually, let me go down to this slide here and right here because it's clean. The first question we ask ourselves is, am I affecting cash? Okay, that's either going to be a yes or a no. If it's a yes, then I make the journal entry by debiting or crediting, the cash account. And since I know what, since I have my debit or credit and I know debits must equal credits, whichever I choose, then I know I have to look for the other. So if I'm debiting cash, I have to credit something else. If I'm crediting cash, I have to debit something else. But when I ask myself, am I affecting cash? And the answer is no, the next question I'm asking myself is, am I affecting accounts receivable or accounts payable? Now here's the thing. If I affect accounts receivable, I treat it the same exact way as cash. Okay? But if instead I choose accounts payable, well, accounts payable and accounts receivable are the same exact thing. It's, offering on credit. The only difference is they're two sides of the same coin being on credit. So the way you think about accounts payable is, with accounts receivable, if my accounts receivable goes up, meaning it increases, I know I'm going to debit it. Well, the opposite for an accounts payable is, if I increase my accounts payable, the opposite side of the same coin is I would credit it. Why? Because it's a liability account, right? And accounts receivable is an asset account. Remember, assets equals liability. What's on the left? Debit. What's on the right? Credit. So that's how I know that when my accounts payable goes up, I credit it. Okay? So I ask the question, do I affect cash? If the answer is no, do I affect accounts receivable or accounts payable? If it affects one of those, I choose that because why? Those are the second most used accounts. Okay, and after doing it after a period of time, it becomes second nature. So that if let's say I credit accounts payable, right? Then since debits must equal credits, since I have a credit, that means I need to debit something else. I have to then look to find out what I'm going to debit, right? But this transaction is slightly different. We are paying off a part of our accounts payable, paying off money that we owe for $150. So it's a transaction. And the first question I ask is, do I affect cash? And the answer to this is yes. Well, what's happening to my cash? My cash is decreasing, right? So we know when cash is an asset, and I increase on the debit side and I decrease on the credit side. So my journal entry is going to start out with a credit to cash. So make sure I indent, and I know that goes in the right-hand column because this is my credit column and this is my debit column. Okay, so I'm going to credit 150. Well, if I have a credit to cash for 150, that means I have to debit something else. Well, what am I doing? Okay, I'm paying my accounts payable. Okay, well, that means I have to debit accounts payable for $150. I back into that account and it makes my journal entry right. I actually don't even have to think about the normal balance of an accounts payable. Okay, I just back into it and I know it's right. Now, to verify it, remember, liabilities, here's the equal sign, right? What's on the right, we credit it. So we increase our liabilities on the credit side. That means we decrease our liabilities on the debit side. Well, we're decreasing our accounts payable, which is a liability, which means we're decreasing it, so we have to debit it, which is what we had in our journal entry just by backing into it. Okay? Right? That's the theory behind it, and it's just that simple. Just keep going, following the same thought process again and again and again. And you don't have to be looking in the book to be trying to find how to make journal entries and trying to mimic this stuff. Think through the thought process. Pause the video, write down what I'm saying, and go through the process. All right. So once we've made the journal entry for the 150, we have new balances again. Okay. And again, I'm not going to go through the math for that. But what I will do is, since I'm at 17 minutes, I'm just going to go through this last transaction here in this illustration. Okay, so for our next journal entry, it's an expense, right? We're paying out something. We're how can this is a cost as far as the operation of our business is concerned, and it's in the amount of $1,700. So let me quickly erase this here. I haven't figured out how to erase all of this real quick. All right, so the amount was $1,700. Okay, so the first question I ask is, am I affecting cash? Okay, and in this case here, the answer is yes, because we're paying cash. So our cash is decreasing, right? So to make let me get the right direction I'm going here. Where did I go? Oh, I'm all the way up there. Okay. So I'm just talking about, I'm looking at the slides in my PowerPoint. That's why I'm babbling to myself. So I'm going to have a debit and I'm going to have a credit, right? And I'm affecting cash, but what's happening to my cash? My cash is decreasing. So I know that I have to credit my cash account in the amount of $1,700. Well, if debits must equal credits and I'm crediting cash for $1,700, that means I have to debit something else for $1,700. And in this case here, the transaction is telling me that I am, it's an expense. Okay. I'm using one of the expense accounts that are on my chart of accounts. All right. So whatever account that is, let's just say it was, I don't know, utilities expense. I would debit my utilities expense for $1,700. I back into that account. All right. I know it's not an asset because it's, when I'm paying my utility, it's not something, I don't own the utility. Sure, you can say I owe the liability for the utility, but the utility is an expense because it's being used in the operation of the business. What I owe is not like an accounts payable, a note payable, a loan payable, or a mortgage. It's not like a bank loan. It's not money that's coming into the business that I have to pay back. This is, our expenses are money that's going out for the operation of the business. So it isn't a liability. It isn't equity because it's not an investment in the business. And it certainly isn't revenue, which is a sale. So I have to choose one of my expense accounts, and I look at my chart of accounts under expenses, and I choose one of those expense accounts that most appropriately fits, and I make the journal entry for 1700. Okay, so in this case here, we're debiting the expense account for 1700 and we're crediting cash for 1700. Right? So we went and covered a revenue account before, and now we're covering an expense account. And notice that our accounting equation is still not in balance because we haven't closed out the accounting period. Right? So with that, I'm going to stop and pick up in the next video. Okay.